All right, let's jump right in. Today, we're taking a look at a really interesting company called BioGaia. Now, these guys are a Swedish healthcare specialist, and they're basically world leaders in this super specific niche, probiotics. The whole business is built around this one unique bacterium, reuteri. And, when you first glance at it from an investor's point of view, it looks, well, pretty darn compelling. But here's the thing. As soon as you start digging into the numbers, you run smack into a really big question. I mean, this company has a fortress of a balance sheet. We're talking zero debt, a ton of cash, and sales are chugging along nicely. So why are its profits shrinking? It just doesn't quite add up, right? What in the world is going on with this super healthy company that's causing its profitability to take a hit?
Well, it turns out this isn't some random fluke. Nope, it's a deliberate and, frankly, a really high-stakes trade-off they're making. You see, BioGaia is right in the middle of this massive strategic shift. They're basically tearing up their old playbook, the one that was super profitable, where they just relied on partners to sell their stuff. Instead, they're going all in, betting the farm on a much more expensive direct-to-consumer model. And this decision, this fundamental choice between the easy profits of the past and the potential for huge growth in the future, that is the absolute heart of the story for anyone looking to invest here.
Okay, so before we get into the risks of that bet, we really need to understand why they feel confident enough to make it in the first place. You have to appreciate just how solid this business is underneath it all. So let's start with the bull case, all the good stuff, the financial firepower and the walls they built around their business. Yeah, at its core, BioGaia has what investors love to see, a deep, wide competitive moat. And if you're not familiar with that term, it's just a simple way of describing the advantages that protect a company from its rivals. For BioGaia, this isn't just one thing, it's really built on two incredibly strong pillars. So pillar number one is all about intellectual property. We're talking over 600 patents granted all over the world. Think about that. These aren't just pieces of paper. They're legal shields that protect their special probiotic strains. It makes it almost impossible for another company to just waltz in and copy what they do. That is a massive wall to climb for any potential competitor.
And the second pillar? Well, you could argue this one is even more important. It's scientific validation. BioGaia has backed its products with more than 250 clinical studies. That is a mountain of scientific proof. And what does that do? It builds an incredible amount of trust, especially with the people who matter most, doctors and pediatricians. They see the data and they recommend the product. It's a genius sales channel.
So when you have a moat that strong, what does it get you? It gets you a balance sheet that is just beautiful. I mean, look at this. The company is totally debt-free. They're sitting on a big pile of cash, and the business just keeps spitting out more cash year after year. That financial muscle lets them be super generous to their shareholders. We're talking a dividend that was yielding around 6% in 2024. That's a serious return.
Now this table, this is where things get really interesting because it tells a story about pricing power. The gross margin, which is basically the profit they make on every single product they sell before all the corporate costs, is just incredibly high and steady. I mean, consistently over 72%. What that tells you is that people are willing to pay up for what BioGaia is selling. They're not competing on price, they're competing on quality and science. That's the sign of a fantastic product.
Okay, so if the business is this strong, what's the catch? Why isn't this a no-brainer investment? Well, now we have to look at the other side of the coin, the bear case. This is where we get into that central challenge for the company, that pivot we talked about, which is turning out to be pretty painful and pretty risky.
And here you have it. This is the other half of that margin story. Remember those rock-solid gross margins? Well, this is the operating margin. And this number includes all the costs of actually running the business, like sales and marketing. And it tells a totally different story. You can see it peaked and then took a pretty big dive. So the company is still making a ton of money on each pill, but it's costing them way, way more to actually get it into a customer's hands.
So what's causing this? It's no secret. It's a direct consequence of that big strategic pivot we've been talking about. Going direct to consumer is just expensive. You have to build out your own sales teams, invest in websites, pour money into marketing on places like Amazon. It all adds up. They're literally sacrificing today's easy profits for a shot at faster growth in the future.
And to make things even trickier, this whole pivot isn't happening in a nice, quiet environment. The company's been dealing with a few other headaches that just pile on the risk. First, they lost a big partnership with Nestle in the US. Then, an R&D project went south, forcing them to write off a bunch of money. And all of this is happening while they're flooring the gas pedal on those expensive D2C investments.
And if that wasn't enough, there are outside forces at play too. The EU, which is a huge market for them, is what you could only describe as a regulatory maze when it comes to probiotics. What that means is companies like BioGaia can't just go out and tell people directly, hey, our product does X, Y, and Z for your health. They're super restricted. Now imagine trying to build a brand new consumer business when you can't even tell people what your product does. It makes the tough job that much harder.
So let's pull all this together. What we've got is this amazing, high-quality company that is deliberately diving into a really risky and expensive transformation. And that brings us to the bottom line, the most important question for any of us as investors. What's the price of admission? What is the market actually charging you to be a part of this story?
Let me put it another way. When you buy this stock, are you getting a fair price for all the risk you're taking on? The risk that this whole direct-to-consumer thing might not work out? Or has the market already assumed it's going to be a massive success and priced the stock accordingly?
And this chart, wow, it just lays it all out there, plain and simple. BioGaia is trading at a price-to-earnings ratio, a key valuation metric, of about 33. Now look at a huge competitor like Yakult. They're at 17. BioGaia is valued at nearly double its peer. The message from the market is crystal clear. This is not being treated like a normal company. It is absolutely being priced for perfection.
So why on earth is it so expensive? Well, it's for all those great things we talked about in the bull case, right? The amazing margins, that rock-solid balance sheet, the scientific moat. But there's another reason, and honestly, it's the biggest one of all. A price tag this high means the market is already assuming that this whole risky, expensive pivot is going to be a grand slam.
And that right there is the key takeaway for anyone thinking about investing. When you pay a premium like this, you're not buying the company as it exists today. You're paying for what you hope it will be tomorrow. The current stock price basically has all the success priced in, which means there is very, very little room for things to go wrong. If this D2C strategy hits a snag, or even just takes a little longer than everyone hopes, that high-flying valuation could come crashing back down to earth.
So it all comes down to this, and the question is really for you to answer. On one hand, you've got a chance to own a piece of a truly high-quality company with an incredible scientific moat. On the other hand, you have to pay a steep price today for a promise of growth tomorrow, and that promise is loaded with risk. So the question is simple. Is that a bet you're willing to take?